Hi, I'm Suzy Rhoades with PassMasters. Welcome to this week's Questions of the Week. This week, our topic is Advanced Debt Securities. You can expect this topic to appear on your Series 7 exam. We will be taking a 10-question topic quiz from within our PassMasters Series 7 online course. Let's check out our learning management system. The call feature on a municipal bond means choices include the investor can require that the broker-dealer redeem the bonds, the municipality can redeem the investor's bonds, the dealer has the right to redeem the investor's bonds, or the investor can require that the issuer redeem the bonds. So the municipality is the issuer of a municipal bond, and the call feature means that the municipality has the right to pay off the bondholders early. The municipality can redeem the investor's bonds. So you check what you believe is the right answer, click check answer. And I know I got it right because I got that green check mark. You can click show explanation and read the explanation. You can also listen. A call feature on a municipal... It's me. So all of our questions in all of our PassMasters courses have audio explanations. This is done to appeal to all of the different learning styles. If a municipal bond is rated capital A by Moody's, it would be considered speculative because of the degree of risk? No. Of higher medium grade? Of the best quality, well, that would be capital A, lowercase a for Moody's. Undesirable? No, it is A rated. It is of higher medium grade. Which of the following comes closest to the meaning of the term double-barreled bond? A joint cooperative effort between a municipality and a private group to build industrial plants? No. A tax-exempt bond issued by a municipality and backed by the moral obligation pledge of a state government? Certain municipal bonds where a taxing authority guarantees debt service payments in the event that pledge revenues are insufficient. Ooh, I like that one. A municipal bond that is trading in both the over-the-counter market and the exchange market. No. So a double-barreled bond is backed by two sources. So here it says certain municipal bonds where a taxing authority guarantees debt service payments in the event that pledged revenues are insufficient. Backed by two sources, double barrel. They are good for investors that are looking for safety of principal. Which of the following securities does not trade with accrued interest? Income bonds, corporate bonds, municipal bonds, or U.S. government bonds? The answer is income bonds, even though it seems strange. An income bond is when an issuer is having financial difficulties. An income bond will only pay interest payments if the issuer can afford to pay interest payments. So income bonds trade flat, which means that they trade without accrued interest. The debt service payment for moral obligation bonds is typically dependent upon. The choices include the Secretary of State, discretion of the municipality, legislative appropriation, or legal opinion validation. Moral obligation bonds are subject to legislative appropriation, and it's never binding upon the legislature. They don't have to back a bond. Even if it is a moral obligation bond, they can choose not to. In an Eastern account for new issue municipal securities, a syndicate member is liable for his share of the unsold bonds until all of the remaining bonds are sold out of the syndicate account. I think I like that. Let's check the others. 30 days after the bonds are available. No. The manager of the account lifts syndicate restrictions. No. He takes down from the syndicate an amount equal to his original liability. No. In an Eastern account, we sometimes call it an undivided account. A syndicate member remains liable for whatever the percentage is. So it says his share of the unsold bonds until all of the bonds are sold out of the syndicate account. The amounts by which the price of a municipal bond exceeds the par value is said to be the discount, spread, premium, or exemption. When a bond is trading for more than par, we say that it is trading at a premium. A municipal bond issued at par was bought by an individual investor on the secondary market at a dollar price of 92 with a 10-year maturity. What are the tax consequences if the investor sells the bonds 5 years later at 98? So when a municipal bond is purchased in the secondary market at a discount, because 92 is less than par, there is no adjustment made to the basis over time, so that the tax liability is simply the difference between the 92 that they paid to buy the bond at and the 98 that they sold the bond at, so a 6-point gain. If an investor is in a high tax bracket and is interested in maximizing current income and preserving capital, he would be most interested in choices include equipment trust certificates, debentures, income bonds, and general obligation bonds. One of those is municipal debt, and that is the general obligation bond backed by taxes. The other three are forms of corporate debt. So when your investor is in a high tax bracket, the best recommendation will be a municipal bond. If a customer wishes to profit from an expected rise in the general level of interest rates, you might recommend that she do which two of the following? So I'm going to use my scratch paper here. I'm going to write the teeter-totter. And we have the nominal yield, current yield, yield to maturity, yield to call. The driver of the teeter-totter is interest rates. And on the other side of the teeter-totter, we have price. And let's see, the customer wishes to profit from an expected rise in the general level of interest rates. So if interest rates go up, what's going to happen to the price of debt in the secondary market? Because all of these are treasury bonds. If the interest rates go up, the price of the bond is inversely related. The price is going to go down. So in order for this customer to profit from an expected rise in the general level of interest rates, what could you recommend? We're going to look for things on the options chart that have a down arrow. So buy, sell, call, put, buy, sell. Arrows go out on the buy side and arrows go in on the sell side. It's the world's fastest options chart. So we have a down arrow on the sell a call, and we have a down arrow on the buy a put. So not buy treasury bond calls. That's a bullish position, and she believes that interest rates are going to go up, which means the price of the treasury bonds are going to go down. Buy treasury bond puts. Yes, 2 is part of the correct answer. Sell treasury bond calls. Yes, 2 and 3. Sell treasury bond puts? No. So be careful with those questions. The teeter-totter is really helpful. So it tied together our knowledge of debt with our knowledge of options. That's how the Series 7 test is. You have to know everything. That is it for this week's questions of the week. Topic: Advanced Debt Securities. If you learned something, be sure to give this video a thumbs up, subscribe to our channel, and turn those notifications on. If you'd like to check out PassMasters course offerings or to enroll in any of our programs, there is a link found in this video's description. Thank you so much for watching. I hope to have you as a student soon. Happy studies! You got this.